Hello and welcome, Nilesh Shah. Thank you so much for joining in today and giving us your time. So, very obvious question, which is the first question, has to be the first question. A new story for debt mutual funds that's playing out?
Undoubtedly, yes. But this amendment has not impacted existing investment or investments which will be made up to 31st March 2023. Those investments will continue to get benefits of long-term capital gains and indexation. From 1st April 2023, investments made for more than 3-year horizon will not attract long-term capital gain tax, but they will continue to get other benefits of debt mutual fund, which is diversification, professional management, and anytime liquidity.
Nilesh, what about what of those investors who want to continue the investments in their debt funds even after 31st March? How will the tax change impact their investment or their corpus?
So, majority of Indian investors will have tax rates below 20%. For them, there is absolutely no impact of this proposal, or this will be beneficial. Earlier, if they invested for more than 3 years, they were getting long-term capital gains tax benefits, which is 20% with indexation, 10% and 20% depending upon your time horizon and indexation benefits. But if your normal tax rate is lower than 20%, then you are better off investing post 1st April 2023. People who are in higher tax bracket, of course, they'll have to pay little higher tax. If you are in highest tax bracket like myself at 39%, you could have got earlier tax advantage at 20% with indexation. Now you will be paying tax at 39%. So yes, there is marginal hit on account of withdrawal of tax benefits.
Investors need to be very smart, in understanding as to how they want to park in their money. But then talking from an AMC's perspective, this was a time where, investor awareness regarding debt mutual fund was actually growing, and tax benefit, indexation benefit was a major hit and a very big reason behind debt mutual funds picking up. At an AMC level, how do you think now the narrative will change from AMCs?
So we'll have to focus on financial education. There are more than 1.5 crore Indians who have lost more than 2 lakh crore over last 20 years in Ponzi schemes and collective investment schemes. We have to educate investors not to go to those kind of Ponzi schemes like EMU and tickwood plantation and real estate and gold and so on and so forth. Second, we'll have to continue to educate investors about risk and return. Mutual funds are marked to market, and hence you see volatility in NAV. But over a period of time, they have ability to deliver real return. We can also create asset allocator solutions, which while attracting higher tax, also ensures that investor is able to do asset allocation in line with the market. As time evolves, there will be more products approved or more products launched. At the end of the day, as long as we are adding value to the investors in terms of real return, I think we'll continue to get their investments.
Let's just talk about, since you mentioned asset allocation, so let's just talk about the available options that investors have, in a debt mutual fund category, and looking at the interest rate scenario. How would you advise them to make the most of the products available? Because in terms of product features and the kind of design the debt mutual funds have laid out, it is superior to a lot of other fixed income instruments. It's just that awareness is not there. Investors don't know much about it, and the way a lot of times these products are pitched over because of the taxation incentive and the benefit over there. Now, since that has gone and the interest rate scenario considered, what products for what kind of a duration you think are still attractive, and one can actually look at these products despite the fact that now FDs and other small saving instruments and other fixed income instruments are at the same level?
So one, mutual funds are more transparent than any other instrument. Our intermediation cost or charges paid by consumer is far lower. And we have product for all the ranges. If you want to invest just for overnight, there is overnight fund. If you want to invest for, 7 days to 30 days or 90 days, you have liquid fund available, which gives you anytime liquidity. If you want to invest up to 6 months horizon, from 3 to 6 months, you have money market funds available. If you want to invest from 6 months to 1 year kind of horizon, you have short-term bond funds available, floating rate funds available. If you want to invest on a longer term horizon, you have PSU debt fund, corporate bond fund, gilt fund, bond fund, dynamic bond fund kind of products available. So depending upon your time horizon and depending upon your risk profile, there are multiple choices available in mutual fund. They are transparent, they are cost effective, they provide you diversification benefit, and most importantly, they provide you any day liquidity.
Good investment, the favorite of Indians, and we always try to have the right kind of investments, for investors, and the kind of taking them away from physical investments and making them invest in better investment instruments as far as gold is concerned. Now, gold funds gone out of this scenario, sovereign gold bond that takes the lead clearly.
Undoubtedly, in sovereign gold bonds, you get coupon income 2.25 or 2.5%, depending upon your maturity. In physical gold, you have to pay what is known as, entry premium. If you buy gold in small quantity, then you pay far more than the market value. In gold ETF or gold fund of fund, there might be a little bit of entry cost, but much lower compared to physical gold. But in gold funds as well as physical gold, you have to pay the cost. In sovereign gold bonds, you actually get interest income. So to that extent, sovereign gold bonds are attractive from a long-term investment point of view.
Lastly, is it a major dampener for international FOFs?
Uh, Actually, there is no impact on international fund of fund because most of the limits are full. Most of our international fund of funds are closed for subscription. They are only open for redemption. And existing investments are grandfathered. As and when the limits opens up, then we'll have to see how investors react to it.
In a nutshell, yes, it looks like a blow now, but also this helps or makes an investor think as to what kind of reasons they have to select an investment instrument, especially when we talk about fixed income investment instruments. Thank you so much, Nilesh Shah, for being on the show and helping our
Thank you.
viewers with this today. Thank you.